Welcome to our comprehensive guide on real estate settlements and closing costs. We'll break down everything you need to know to understand the closing process and pass your real estate exam. Let's start with a practical example. Suppose we have a house with a purchase price of $300,000. The buyer plans to make a 20% down payment. Let's calculate this amount. Before we dive deeper, let's understand debits and credits. A debit represents money flowing out of an account, what you need to pay. A credit represents money flowing into an account, what you receive. Think of it like your bank account. When you spend money, it's a debit. When you receive money, it's a credit. Let's create a sample closing statement. For the buyer, the purchase price of $300,000 is a debit, money they need to pay. For the seller, this same amount is a credit, money they will receive. Now, let's understand prorated items. These are expenses that need to be split between buyer and seller based on the closing date. Let's look at property taxes as an example. If annual property taxes are $6,000 and the closing is on July 1st, exactly halfway through the year, the seller would credit the buyer $3,000 for the remaining 6 months. Finally, let's discuss transfer tax and recording fees. Transfer tax is typically calculated as a percentage of the purchase price. For example, if the transfer tax rate is 0.5% on our $300,000 purchase, that would be $1,500. Recording fees are flat fees charged by the county to record the deed and mortgage documents, typically a few $100s. And that's our comprehensive look at real estate settlements and closing costs. Remember, debits are what you pay, credits are what you receive, and always pay attention to prorated items and required fees. Good luck on your real estate exam.